right, so business owners, real estate investors, so the Federal Reserve reduced the interest rate by 0.5% today. So what does that mean for you if you are looking to get an SBA loan, a business loan, or maybe even a mortgage? I'll talk a little bit about that on the commercial mortgage side. So let's just a quick summary. So there's three types of SBA loans, and just working with business owners, they're concerned about, okay, well, if I get a particular type of loan or SBA loan, what interest rate could I potentially have? And again, there's three types of SBA loans. There's the SBA 7A loan, the SBA 504 loan, and then there's the micro SBA micro loans that goes up to 350,000. The SBA 7A loan, that loan is tied to the prime rate, the Wall Street Journal prime rate, and typically those rates are variable that's tied to that, and it's prime plus a margin percentage that the financial institution charges, and usually that is 2.75%. And the SBA 504 loans, those are fixed rate, and those are influenced by the U.S. Treasury bond yields. And I'll talk a little bit about how that works with the federal interest rate. And then the SBA microloans, those rates are set by the intermediary lenders, the small business lenders, usually CDFIs, but are often based on the prime or similar benchmarks. They'll like add their margins on it. And just so you understand, the prime rate, or the rate, Federal Reserve rate that they charge, usually the bank, that's the interest rate that the banks borrow from the Federal Reserve, and then the banks typically will pass on that, that difference between the two. So like if the Federal Reserve interest rates go up, that's why the interest rates that you borrow went up. If the if the Federal Reserve rate goes down, then typically that's when our interest rate will go down. So in summary, so the Federal Reserve rate cuts influences short-term rates directly, and long-term rates like the 10-year and 20-year Treasury bond yields indirectly. And how that works. So as the Federal Reserve rates lowers their rates, Treasury yields are often fall because investors expect a lower future inflation and interest rates. So, and that's with the investors, they're buying the bonds from the US Treasury so that they can, usually it's safe harbor for not only countries and investors to put their money. The lower Treasury yields, and I'm not going to get into if that's true or not. It's dependent on you as the investor, but traditionally that's what's happened. And lower Treasury yields mean cheaper financing for businesses, especially for fixed rate loans. Like again, we talked about the 504 program, which bases its rates on Treasury bond yields, and Treasury reserve rates cuts typically lead to immediate decrease on the Wall Street Journal prime rate. It's mainly, in that prime rate influences business loans rates, SBA loans, like we talked about, mainly the 7A, consumer loans, anywhere from car loans, credit cards, student loans, making borrow cheaper when the Federal Reserve reduces its rate, because that's their rate. They lend to the banks then lend to us, right? Or sometimes like other lenders like myself, unfortunately we don't borrow directly from the Fed, so we sometimes borrow from banks and other places where they're trying to get yield on their funds and use those interest rates as a benchmark for their yields, because they're looking at, okay, can I borrow money from I mean, can I give money to the federal government and get a return on my investment there? Can I get it to private credit like we do? Where can we get a yield, the most yield based on the safe harbor of what that investment wants to yield? All right. Well, hey, definitely join our Keys for Business masterclass where we show business owners how to access capital actually without getting out a loan or providing investment in your business, or without putting up assets like your personal residence, your home. All right. Thanks for watching.